Good afternoon, ladies and gents. It is a beautiful day here in Connecticut, and I'm in a nice abandoned office that isn't even mine. That's because there isn't enough room for me. My actual office, guess I'm not important enough, but yet to be grateful for what you have because it could always be worse. So today, we are going to get into life insurance. We will go over everything you need to know to determine which type, how much, or if you need it at all. And yes, there are multiple types and it can be tricky, but I'll walk you through it. Okay, without further ado, the first type of life insurance is called term insurance. Now, it is called that because it only lasts for a specific term, usually 20 to 30 years. Now, I know what you're going to ask. Why would I get insurance that's going to die 20 or 30 years? The reason is because you could get a lot of insurance for very cheap. Now, I'll paint you a little picture of why someone would get term insurance. And I'll use my dad as an example. So the year's 2000, my father's 26 years old, I was not even one yet, and my mother was pregnant with my brother. And to top it all off, my parents had just bought a house. So my dad got a $500,000 30-year term policy on himself. The reason was that he was the sole provider. So if anything happened to him, my mom would be stuck between a rock and a hard place. But since he had the term policy, if the worst were to happen, my mom could pay off the house and be able to stay on her feet long enough in order to get a job. Now that policy is going to die in like 5 years' time. And the way I look at it is that's okay because it served its purpose. The house is almost paid off. Me and my brother, we're working now. And my dad no longer needs that much insurance. So to sum up, the term lasts for a specific number of years, usually 20 years or 30 years, then it dies. It is the cheapest way to get the most amount of insurance. And you just have to look at your specific circumstances and determine what it is that you're insuring against. But what if you don't need $500,000 of insurance? What if you need just enough to cover final costs and leave the kids a little something? Well, the other main type of life insurance is whole life. Now there are a few variations to whole life, but that's for a whole nother video. For now, whole life differs from term life because it is guaranteed to pay out. It lasts for your whole life or until age 100 when it endows. Now that just means if you're lucky enough to live to 100, it will pay the face amount. And there's two parts to this whole life insurance. There's the face amount and the cash value. The face amount is simply the amount of insurance you buy. If you buy a $100,000 whole life policy, it is $100,000 that your beneficiary will get when you pass away. The other part of a whole life policy is the cash value. Now this is based off the premium payments you pay. As the years go on and you keep paying into your policy, the cash value builds and it earns around 1 to 4% each year depending on the insurer. And you have a couple of options when it comes to your cash value. Now, one of the options is you could borrow against it. So let's say you have that $100,000 policy and your cash value is $10,000, but your car broke down and you need to buy a new one. Well, you could take $10,000 from your cash value and use it as a down payment on the car. Now, this is not an endorsement to do this, as you do have to pay yourself back, usually with an interest rate of around 4 to 5%, which has been better than banks as of recently. So if you are making a big purchase, like a house or a car, it may or may not be worth it to look into it, to see which makes more sense, whether getting a loan from a bank or borrowing against your policy. But the last disclosure about borrowing from your cash value is if you die before you pay the policy back. So for example, let's take that $100,000 policy one last time. If you borrowed $10,000 from the cash value and you died, your beneficiary will only get $90,000. Make sense? So it's the face amount minus the amount borrowed equals the death benefit in that case. There's two more interesting things that you can do with cash value. At any point, you can forfeit the policy, take the cash value, which means you no longer have life insurance, but you will get the full cash value in return. So it's a bit of a trade-off, catch-22 there. And the other thing you could do typically comes at age 65. In a lot of life insurance policies, you have the options to no longer make premium payments and still maintain coverage. Seems too good to be true? It really isn't. Because by no longer making any premium payments after age 65, you will agree to a reduced death benefit. So that $100,000 policy may drop to $80,000, $75,000. But after 65, you don't have to pay another nickel. So it may be worth looking into. Now, this is a brief overview of life insurance, and I can make hours of content on this subject, and I probably will. So if you have any questions or want something explained in another video, drop it in the comments. But one thing I really want to harp on is when it comes to insurance, everything is situational. And what I need is not going to be what a mother of 3 needs, is not going to be what someone who's about to retire needs. There is no best insurance coverage because it comes down to the individual situation. So just keep that in mind if someone is saying like you need this certain coverage. Lastly, if you like this video and you got value from it, leave a like and subscribe so I can keep making content like this. Thank you all for watching to the end of the video, and if you're in Connecticut and want to connect personally, check out my channel and send me an email, Sean@brbginsurance.com. Deuces.